this video, I want to give us some perspective as Lemonade investors. On the surface, it's been a really bad month as Lemonade investors. Stock went from $22 a share down to about $13 a share where we're at now. A horrible decline. A lot of investors, as the stock falls, losing a lot of patience, having a lot of frustration, losing hope in the company. And nothing on this channel is personal financial advice, not advice at all for you, but I want to give my perspective as a long-term investor. I still think the thesis is on track. I still think it's yet to be proven wrong. And while it is frustrating to see the stock go down like it is, that the stock and the actual company's performance can be completely unhinged from one another. So while there may be some valid concerns with Lemonade, while Lemonade could certainly fall and fail and maybe even not make it and go bankrupt someday, well, those are all certainly possible outcomes. I don't think it's as bad as the market decline has shown over the last month and a half since earnings. So I hope this video gives you some perspective and also gives you maybe some reason to have patience and potentially even show you that you could think of this as an opportunity if you still believe in the long-term thesis of Lemonade. Of course, I'll leave that up to you. This was a great letter clip from Warren Buffett's 1997 Berkshire Hathaway letter, and I'm not going to read the whole thing. You can find this on my Twitter feed, August 28th. And he basically explains, hey, if you expect to be a net saver for the next 5 years, then you really should hope that the stock market stays lower so you can buy more great assets, more great companies at lower prices. Basically means what you want to buy is on sale. So if you're still a believer in Lemonade, you're still trying to accumulate shares in Lemonade, which is certainly the camp I would fall into, then hey, this is a great opportunity that I can buy shares for longer at great prices if I still believe in the thesis long term. And I tweeted this tweet out on August 4th, and I still believe this holds true. I said Q2 loss ratio for Lemonade was bad because catastrophic events were especially bad for Lemonade and also other insurers, which affected especially their home products. And most of the car business is from Metro Mile and is in California, and rate changes there are way behind. Both of these should be fixed. Shouldn't have as bad a catastrophic quarter every single quarter. Shouldn't happen in theory. And also the rate changes in California should start to take effect, and it would solve both of those problems around the loss ratio. Otherwise, I think Q2 was a pretty solid quarter. You might wonder, why was Q2 a pretty solid quarter, or at least on some of the metrics, a solid quarter? Well, if you look at customer churn on a 12-month basis, so basically the amount of customers that churn from 12 months prior, we're down to, it's actually below 20%. It's 19.5%. This trend continues to fall downwards. Super positive trend, basically meaning you're getting more stable customers that stick around longer and last longer, and maybe have more products bundled with Lemonade, so they're less likely to churn, probably less of those renters only customers that maybe have more transient life and come and go or change their rental property or rental needs and rental insurance requirements. Another metric that's improving is the amount of in-force premium they're gaining for the amount they're spending on customer acquisition or ad spend, or what I'm also calling sales and marketing variable, their ad spend or customer acquisition cost expenditures. That ratio was around 2 and then grew to around 3, but was probably more like 4.5 last quarter. And that could be in part because they're trying to slow growth. So you're cutting back on some of the higher hanging fruit, and in that quarter really grabbing the lowest hanging fruit so you have more profitable marketing. For example, they only spent about $98 per customer gained in ad spend in that quarter versus other quarters that 128, 170, somewhere in the mid 150 range. But still, really positive to see this metric improving where they're gaining more in-force premium for their amount they're spending. And I do think this ratio in general is going to keep climbing as they have a customer group and a customer base that ages and has that gathers and gets more products and bigger ticket products. Lots of examples are many of these customers in the current customer pool would maybe only have renter's insurance and spend $100 a year on renter's insurance right now, and then they get a home and suddenly they're spending $2,000 more on the home. Maybe it's like a 20x increase in their premium for that type of customer. So I do think this number is going to keep rising. Longer term, I have a 5, 6, 7, 8 kind of ratio climbing out into the future years. Another positive thing is our Q4 guidance is looking stronger. So if you look at Q3 guidance, which they give adjusted EBITDA of about $50 million loss they're expecting. They don't give specifically Q4, but they do give a full year guidance of around 196 to 199 million loss in adjusted EBITDA. So if we looked at, I tweeted this out back August 2nd, right after Q2 earnings, was Q1 was 51 million, Q2 53, Q3 is going to be 50 million, is roughly what they're expecting a full year, about 197. From that, you can do the math and figure, well, that adds up, works out to Q4. They're thinking it'll be about 43 million. So starting to turn that corner in a more positive direction. Now, if we look at a quick overview of the next 2 quarters, the balance of 2023, and starting with their guidance, they're guiding in-force premium of, low 700s in Q3 and then 700 teens kind of at the end of the year. So pretty small amount of growth. I've modeled it slightly higher than these numbers because typically they've had a history of beating this in-force premium growth. So I have Q3 of 714 million and 721 at the end of the year. And I have a loss ratio coming down from 94% to 87% and then down to 82% in Q4. You put those numbers in. This is in my sales and marketing churn block of numbers here. I explained this in other videos, but I do my modeling of this area based on the churn. So I look at what's the customer churn, because I think that's fairly predictable and it's been steadily coming down. So I start with what's the churn going to be, and then what's the customer acquisition cost going to be. So I put in $120. Could be higher than that. I mean, last quarter was only 98 because I think they're targeting more renters insurers versus less so of other products right now. But I think it's a good chance it's higher and closer to where it's been more historically. Put in $120 for that and 19.5% for customer churn. And then synthetic agents, I have a synthetic agents block here saying how much percentage of your customer acquisition spend is going to be covered by synthetic agents. And then how much, say if it's 20% is being covered, how much the synthetic agents are spending or chipping in for, and then how much interest Lemonade is paying for those synthetic agents. And I've calculated this interest for different percentages based on a cohort model. I won't explain that there right now, but from that is where I've given those inputs. And you can see as it's helps them now where synthetic agents are spending more than Lemonade is spending out of their interest. But then down the road, this drops off. Say there's no synthetic agent effect later on, but Lemonade still has to pay that interest off over a period of time, or pay that loan off plus the interest, I should say. I have other insurance expenses, just modestly growing. Tech development, I have modestly growing. Fairly flat. G&A, modestly growing. And then total expenses, and I have about 98 million for this quarter, 96 million the next quarter. And as a percent of GEP, we're at 58%, fairly flat from where we were last quarter, and then starting to come down 55%. And that number has been dropping. Some people complaining about their operating expenses. Sure, I'd love it if they could cut OPEX even further, but it is coming down as a percent of their gross earned premium. If you think back, we're at 57% right now. A year ago, we're at 81%, and year before that, we're at 102%. So is continuing to drop. Should continue to drop. I mean, eventually this operating expenses as percent of GEP is going to have to come down to, maybe 15%, maybe even less if we can do that. But that is continuing to improve, another positive sign for the company. I have stock-based compensation of about 15 million. Put in all these numbers. I have adjusted EBITDA of next quarter of minus 50 million. And then in Q4, there was a small effect. Again, I don't really know how much synthetic agents they're planning to use. use, but I'm assuming only 20% coverage by synthetic agents. So basically a fairly small line of credit loan that they would be using, and that gets me down to adjusted EBITDA of $42 million. So right in line with where guidance is showing for Q3, and what I'm calculating is their sort of guidance for Q4. And if we look out over the next few years, I'm still looking at profitability maybe in 2026. It's harder to predict the numbers of the next couple years because I don't know how much of the synthetic agents they're really going to harness and use. Like, it's basically a big line of credit they have that then they, but how much of that line of credit do they want to pull from? But I'm showing, much higher growth in 2024 as their rates are more in line with where they need to be. So more further sort of pedal to the metal growth, 2024, 2025, 2026, where you're going from right now, 600-700 million IFP in a few years, 2020, end of next year, 1.1, year after 1.6, year after 2.2 billion. In IFP. And loss ratio I have coming down into the mid 70% over that time frame. Of course, there's going to be worse quarters and better quarters, and then fairly flat with sort of modest increases in a lot of my operating expenses. But still, as a percentage of gross earned premium, I have these different operating expense lines continuing to trend down. So other tech development, again, coming down as a percentage, all of them coming down, and total expenses, total OPEX coming from, about mid 50% down to 27% at the end of 2026. One thing to note, over the next few years, it will be interesting as they use their synthetic agents. Their adjusted EBITDA could actually look quite a bit better, and I might want to then more focus on the cash flow, because adjusted EBITDA won't include the interest that Lemonade is paying to the synthetic agent loan or lender. So in that sense, synthetic agent or the adjusted EBITDA could get quite a bit better if they ramp up the synthetic agents, but still, numbers won't lie when you look at what their actual cash flow is. Either way, whether you're looking at just cash flow or adjusted EBITDA, I'm still getting to it reaching a positive value somewhere around mid to later 2026. Did ask about this at Q2 earnings, when you laid out your path to become profitable between 2025, 2027 Investor Day, a few quarters forward to where we are now. How are you progressing? Can you give us a timeline update? And Shai didn't give us a lot of information. We said, based on what we know today, we're seeing little changes in our multi-year break-even timing. When we shared long-term financial scenarios in November, it was before synthetic agent funding and before a notable improvement in our EBITDA. So we plan to work that into our long-term planning and give a more updated view shortly. So I hope this gives you some perspective on the company. If you're like me, I still believe in the long-term thesis. I still believe it's yet to be proven wrong. That doesn't mean they won't fail. Doesn't mean even before that there wasn't a chance that they would fail. But if people are asking me, hey, are you selling your shares because they're at an all-time low? I think that is the stupidest logic you could tell me, that now it's time to sell my shares because the stock is at an all-time low. That literally makes no sense, but yet people suggest that and ask that on the internet or even in person often about buying and selling equities. Hey, it's at an all-time low. Is it now the time to sell it? Makes absolutely no sense. But that's what people do on a daily basis in our world and as investors. But for me, that makes no sense whatsoever. And if anything, there's a better buying opportunity to add more shares of Lemonade. And while the company's still, not guaranteed success by any means, I think the decline we've had is pretty ridiculous given where the quarter actually came in at. And I hope I highlighted some of the positive things from the quarter that I've seen. Love to hear what you guys think so far of this decline in price. So let me know in the comments down below. Find me on Twitter, or X now, at PaperBagInvest. And remember, it's in the bag.